Good morning and welcome to Forex In Four. Today is Thursday, April 11th, 2011. All right, this morning, wow, we're seeing a little bit of a respite here from the selling that we've seen over the last couple of days, and the volatility's just been extraordinary. And it goes from stock indices to the currency market to commodities, you name it. Everything is all over the place right now, which means we have a ton of volatility. All right, volatility just means that there's a lot of price movement moving in either direction. Typically, volatility does pick up though if the movement is to the downside. So that's what we're seeing in the markets. And right now, what we're looking at here is I've got a 30-minute chart up of Euro versus Swissy. Okay, and you can see here earlier in the week that it got back to just about 70 pips away from parity, Euro with the Swiss franc. And right now we have Euro actually gaining versus the franc, so the franc is weakening. And there's no surprise here that the SNB, the Swiss National Bank, is they're trying to weaken the franc because it's going to hurt the economy. They lowered interest rates. All right, they said that they're going to be providing more francs on the market, and so far that's done nothing. Well, now they're floating the idea that perhaps they're going to peg the Swiss franc to the euro, which means that if euro goes up, Swiss franc goes up. If euro goes down, Swiss franc goes down. So it's going to be similar to what China does with the US dollar. So it's going to be interesting to see what happens out of that. But as you can see here, the market's maybe taking them a little bit at face value here, bounced off this 102.50 area. All right, and we're up in the 105s now for euro Swissy. All right, just want to take a quick peek here and just show you S&P 500. We're looking at it again, 30-minute chart, and we're a little bit higher here today. Start the day. It looks like the range is starting to tighten a little bit. So we've had this wild volatility with these wild ranges, and now it just has to sort of tighten itself up for a little bit and see what's happening. So we're looking at that. But the major news is it's sort of like when it rains, it pours, and we're looking at Euro USD right here. All right, yesterday the big rumors being floated around was that there was a problem with one of France's largest banks, SocGen, all right, that they were having a liquidity crisis, that they weren't going to be able to fund operations, blah blah blah. The short and long of it is that these are rumors that are starting to hit the market and hit the tape. And when these things occur, when markets are so fragile, all right, it's just going to increase the volatility. So as of right now, all right, SocGen, as they're informally known, they've come out and they've denied any of these problems, and they want an investigation done to see who's floating these rumors, what have you. But sometimes where there's smoke, there's fire. All right, I'm not saying that there is a problem with SocGen, but it doesn't necessarily mean that there isn't a problem. So we obviously know what's going on with the euro debt crisis, and nothing has changed despite the the theater that we had here in the U.S. with the debt ceiling debate, the S&P downgrade, so on and so forth. And you guys have been following this here. Just yesterday, you can see that we've had markets selling off and we've had flight to safety. I just want to show you gold. All right, gold hit all-time nominal high again, just up over 1,800. All right, looks like it got up to about 18. I don't know, whatever this is, 1812 yesterday before pulling back a little bit. All right, we also had oil move higher. Okay, oil moved higher. In addition to this commodity trade going on, there was a drawdown in supply. So people are thinking, well, now supply and demand takes place. So oil went up yesterday. It's pulling back today as well. All right, just want to show you some other things in the market that are looking just a little bit questionable. All right, we'll show you dollar yen here. Okay, you can see this little move. I'm just going to put this up on the 15-minute chart because you can see it better. You can see this move right here at the London Open. All right, for dollar yen. You can also see it for euro yen. Not as dramatic. And then also for pound yen. All right, now there's some talk that the Bank of Japan is actually in the market, all right, and they're actively selling yen, but not an official intervention. So it looks like what they're trying to do is they're trying to spook speculators out of these long positions, all right, to try and keep the currency weak. So it's kind of like if you're somebody who starts buying yen and all of a sudden you just get this massive selling that blows you out of your position. All right, if it happens enough times, you might say, all right, maybe I should take my toys and go home and go somewhere else. And I think that's what the Bank of Japan is trying to accomplish here. So, the question was posed to a Ministry of Finance official this morning, asking, hey, was the Bank of Japan active in the market this morning? And he declined to comment. So, that's a little bit questionable, but perhaps we're going to see that out of Japan. So you see that, these countries that are off, considered safe havens, all right, have been trying to do everything they can to weaken their currency, whether it's Switzerland lowering interest rates and talking about a potential peg to the euro, or whether it's Japan doing actual interventions or just jumping into the market and selling. But you see here that the pain that they're experiencing for higher currency prices as a result of the global crisis that's going on is potentially going to hurt them. So we may see them weaken, and we may see money come back towards the dollar. I mean, even though Bernanke says hey, we're going to keep interest rates extremely low through the middle of 2013, all right, we may see money start coming back to the dollar because not only is the dollar a safe haven. All right, and you can look at it from the perspective of, okay, when things are bad here, people don't want to own the dollar. If there's no interest, you don't want to own the dollar. But from a liquidity perspective, all right, people have to own the dollar. If there's a fear that there's not going to be enough dollars to go around, people are going to rush to the dollar. You need to have dollars if you want to buy oil, if you want to buy gold, if you want to do business between countries that don't accept each other's currencies, things like that. If China and Brazil wants to do business, all right, they're probably using the dollar as an intermediary currency right now. All right, maybe that's going to change. That's the function of the U.S. dollar as the world's reserve currency. All right, so if there's a liquidity crisis going on, people are going to run to the dollar. And quite frankly, with the dollar as low as it's been versus all these currencies, a little bit of dollar strength wouldn't be a horrible thing. But the problem with dollar strength is that we know about the correlations. We know what that does to stocks. We know what it does to commodities. Which again, I think lower oil prices is actually a good thing. Everybody will tell you no, it's bad because oil trades with the market, and if oil's up and the stocks are up, blah blah. Listen, we need low oil to keep prices lower and to ward off inflation. All right, the problem is that I think we're facing a very large deflationary cycle. Okay, especially in the wake of these downgrades. All right, especially if money becomes harder to borrow, that's going to reduce demand even further, which is going to cause prices to fall. Well, Bernanke's doing just about everything he can to try and keep prices elevated. All right, and whether it's gasoline prices, food prices, or home prices, which quite frankly are the most important, he's doing whatever he can there. So I'm not saying that I agree with the program, because I most certainly don't, but that's what's taking place. So I just want everybody to be aware of it. So that's kind of what's been happening in the market. Just show you here from a fundamental perspective in Australia. You can see the Aussie dollar popped a little bit down and then moved higher earlier this morning. That was on the Australian unemployment report, and basically it came in a lot worse than they were expecting. I believe it was they were expecting the unemployment rate to stay steady at 4.9%. All right, and it actually rose to 5.1%. And that was a result of a decline of jobs. It was just a small decline, but they were actually expecting an additional 10,000 jobs to be out there. Just want to show you New Zealand as well. Okay, the Kiwi actually moved higher as well, doing the same thing, but they had consumer confidence figures that came in, and believe it or not, they came in much better than expected. All right, so that's a good thing down under there, and well, I guess down under is Australia, but it's a good thing in New Zealand that's happening. So right now it looks like the markets are just trying to settle itself and find some support, find a range that is a little bit back to normal. All right, we have we know about all the problems that are out there, but barring these rumors that pop in from time to time, all right, things appear to be stable for now. So these bankers are doing what they can here, and I wouldn't be surprised to see some sort of coordinated action if markets continue to slide. But for right now, it appears that we're going to be a little bit stable. I'm not saying, hey, this is it, just jump in long here, but you can get long. Just be cautious, and of course, if things look like they're turning around, get out quickly. So that's what we're looking at today, folks. Good trading to all.